San. When writing conversational English for a natural, highly realistic TTS system, it is crucial to mimic the messy, spontaneous nature of human speech. Here are the key conventions and disfluencies to employ throughout the entire script. 1. Fillers and disfluencies. Use words uh, like, you know, so, and right frequently. These should not just appear at the beginning of sentences, but in the middle of thoughts, especially when a speaker is explaining a complex concept or reacting. Example. Well, if you think about it, building your own center is, it's basically like building equity.
Mm.
2, stutters and restarts. People often start a sentence, change their mind, and restart the phrase, or stutter slightly on a word. Example, the regulatory burden is it's completely massive, or they basically have to start from scratch. 3, back channeling and active listening. Break up monologues by having the listener interject with short acknowledgments or reactions without entirely stopping the main speaker's flow. Example, expert speaker. They file over 2,000 documents a year. Host speaker. Wow, expert speaker. And that's just for one single facility, right? Host speaker, that's insane. 4, interruptions and overlapping dialogue. Use hyphens to show a speaker being cut off or finishing someone else's thought. Do not use ellipses. Example, host speaker. So when the bank decides to...
Yeah.
Expert speaker. Switch vendors. Yeah, the knowledge walks right out the door. 5, colloquialisms and informal phrasing. Use contractions. It's there. And casual transitions. Instead of furthermore use, and the other thing is, but wait, there's also AX. Pacing. No speaker should talk for more than 3 or 4 sentences without the other chiming in, even if it's just a simple right or a clarifying question. This keeps the energy dynamic. 6, pacing. Natural notes.
Welcome to the deep dive. Today, we're looking into something that is really the hidden engine of global finance. We're talking about India-based global capability centers, or GCCs. And, for this one, we brought a massive stack of incredibly detailed sources to the table.
We really did, yeah.
Yeah, we're looking at industry playbooks from Reliable Group and GCC and DA. We've got a sweeping regulatory impact report from Team Lease RegTech. And honestly, the crown jewel of all of this, the really fascinating one, is an actual highly detailed internal KYC and AML policy document.
Right, from the Central Bank of India.
Exactly. So our mission today, for you listening, is to uncover exactly how the world's financial crime defenses run in these offshore centers. We are going to detail the really grueling, rigorous steps of customer due diligence, the intense daily monitoring of suspicious transactions, the crushing burden of international standards, things like FASIA and Basel III.
Oh, yeah, the regulatory alphabet soup.
Right. And also just the blunt reality of what AI actually looks like in modern banking. Because, think about this for a second. When you pull out your phone and you tap your banking app, you expect, seamless magic, right?
Just instant gratification.
Yeah, your face is scanned and poof, thousands of dollars fly across the globe in seconds. And the bank's marketing team, they point at the screen and call it frictionless finance.
Oh, they love that phrase.
Right. But the real control point guarding that transaction isn't some humming supercomputer sitting in a vault in New York or London. It's actually a massive, 1,000-person execution factory in Mumbai or Hyderabad, manually clearing alerts, tracking down missing paperwork, and fixing past audit failures.
What's fascinating here is that the boardrooms in those Western headquarters still refer to these massive operations simply as the back office.
Yeah, like it's just filing papers or something.
Exactly. They treat it like a purely administrative function, when in reality, these India-based centers, they are the absolute critical infrastructure of global risk and compliance. If that facility in Hyderabad goes offline, the global bank essentially goes blind.
Wow. Which I guess brings us to the core question here. Before we look at how they fight financial crime, we really need to understand the mechanics of, why the world's largest banks are so aggressively shifting these operations to India in the first place.
Right, because it's a huge shift.
It really is, because historically, banks would just outsource this stuff. They would hire a massive third-party vendor, pay a flat fee, and basically wash their hands of it. But the data in our sources shows a massive pivot away from vendors.
Total pivot.
India now hosts over 55% of the world's global capability centers, and they're generating $64.6 billion in export revenue. So why the shift from hiring a vendor to actually building their own centers? The playbooks call this the COPO model, right?
Right. Company-owned, partner-operated. And it really comes down to a realization that outsourcing compliance to vendors created 3 fatal basically compounding problems for financial institutions.
Okay, what's the first one?
The first is data control. When you're dealing with global financial crime, moving sensitive transaction data completely outside your corporate firewall to a third-party vendor is, well, it's a massive vulnerability.
Yeah, that makes sense. You don't want a vendor accidentally leaking your client's wire transfer.
Exactly. And the second problem is institutional knowledge. Say a vendor's analyst spends 2 years learning how to perfectly untangle a really complex money laundering alert involving your specific banking products.
Right.
Well, that knowledge belongs to the vendor. If the bank decides to, switch vendors to save a few dollars next year, all that hard-won expertise walks right out the door, and the bank essentially starts from zero.
Okay, let's unpack this for a second. So building a GCC is basically the corporate equivalent of building equity rather than paying rent.
That's a perfect analogy, yeah.
Right. Because when you outsource, you're just renting your compliance defense. Every month you pay the fee, but you own nothing at the end. But when you build a company-owned center in India, every process learned, every mistake fixed, every new regulation that you adapt to it compounds knowledge inside your own organization.
That is the exact mechanism driving this. And the third fatal problem with vendors involves the regulatory audit itself.
Oh, right.
We-
Because regulators don't care about your vendor contracts.
Not at all. Regulators today, whether it's the Fed in the US or the FCA in the UK, they do not accept, oh, our vendor handled it as an excuse.
Yeah, that's not going to fly.
No, you cannot pass a rigorous modern regulatory audit if your defense relies entirely on third-party documentation. The regulators want to see your controls, your governance, your direct oversight.
Right. And I want to look at the financial math on this too, because the reliable group source lays out numbers that are just staggering.
The margins are wild.
They really are. They point out that vendor markups on banking operations usually run between 40 to 60% above the direct cost of the employees and the infrastructure. So when a bank opens an owned India center, that entire margin layer just evaporates.
Poof, gone.
Yeah. And the playbook states that private equity-backed financial roll-ups are achieving EBITDA margin lifts of 400 to 700 basis points simply from this structural arbitrage.
Which is huge.
Wait, 400 to 700 basis points?
Yeah.
Let's break that down for someone who doesn't, stare at EBITDA spreadsheets all day.
Sure, so a basis point is 1/100%. So 400 to 700 basis points is a 4 to 7% increase in pure operating profit margin.
That's massive.
In the banking sector, where margins are often razor-thin and heavily scrutinized by public markets, a sudden 7% jump in profitability without launching a single new product or acquiring a single new customer is an absolutely astronomical leap.
It basically changes the entire valuation of the company.
Exactly. It's a game changer.
There is this wild case study in the sources about a U.S. mid-market commercial bank that illustrates this perfectly. They were drowning in remediation work, basically having to go back and fix thousands of customer files that didn't meet current regulatory standards.
Right, the dreaded KYC backlog.
Exactly. And they couldn't afford to add the headcount in the U.S., so they partnered to launch a COPO entity in India. And in just 6 months, they built a 40-person operations team.
6 months is incredibly fast for banking.
Oh, yeah. And by month 9, this brand new team in India was processing 60% of the bank's entire remediation volume. And the structural savings from, not paying a vendor markup were so massive that it fully funded a second phase expansion into complex risk analytics.
Which is brilliant, right? They essentially used the savings from the manual grunt work to fund their own evolution up the value chain.
Right. But this brings us to a massive contradiction in the source material. We've established that the math makes total sense. Banks build these centers to handle global compliance efficiently and cheaply. But the moment they land in India, they hit a brick wall of local bureaucracy.
Oh, the bureaucracy is intense.
Just setting up these compliance hubs triggers a tidal wave of local regulatory burden that is almost, it's almost comical.
It is the great paradox of the GCC boom, and the Team Lee's RegTech report documents it meticulously. You've got these banks moving to India to streamline global compliance, but a typical GCC in India faces over 2,000 local compliance filings every single year just to operate the facility.
Picture this, right? You're running a mid-sized GCC in a special economic zone, an SEZ in Karnataka. You have 1,000 employees. Sounds manageable, right? But for that specific single facility, the report lists exactly 537 distinct compliance obligations.
And those are not one-time setup tasks either.
Right.
When you break down the frequency, That facilities management team has to execute 81 monthly submissions, 185 quarterly submissions, and 194 annual submissions.
Wow.
And they are reporting to 18 different regulatory authorities across central, state, and municipal governments. We're talking everything from labor laws and provident funds to environmental waste disposal and corporate governance.
That is over 2,000 filings a year. That means every single working day, this center is pushing out 8 to 10 different legal filings just to keep the lights on. And that's before their analysts even look at a single suspicious global bank transaction.
Exactly. And the CEO of Team Lease RegTech raises a critical point about this environment. He asks, how can these centers possibly act as high-velocity engines for predictive analytics and global cybersecurity if their own physical operations are bogged down in manual reactive compliance?
That's a very fair question.
If the facility management is relying on, spreadsheets to track 2,000 annual filings across 18 different portals, they run the very real risk of being what he calls compliant by accident.
Compliant by accident. That's a great phrase. But I have to push back on the narrative here, though. If the red tape is actually this thick, thousands of filings, 18 different authorities, the constant threat of missing a minor labor filing, shutting down operations, why is the sector still exploding?
It's a fair pushback.
Right. Because the report itself notes that salaries for top AI and cyber roles in these Indian GCCs are rising 18 to 22% annually. If the friction is so bad, why aren't the banks packing up and moving to a lighter regulatory jurisdiction?
Well, because the sheer scale of the talent pool entirely offsets the regulatory friction.
Oh, interesting.
There's basically nowhere else on Earth where a global bank can hire thousands of highly educated English-speaking finance, risk management, and analytics professionals at that speed. The banks are willing to absorb the local bureaucratic friction as a cost of doing business.
Ah, I see.
And furthermore, the local governments are beginning to recognize that they cannot kill the golden goose, so to speak.
Right.
The source highlights that Karnataka's 2025-2026 budget introduced the Employers' Compliance Decriminalization Bill.
Okay, wait. So they are replacing the threat of criminal prosecution with just, civil fines?
Precisely, because historically, a missed quarterly labor filing could theoretically result in an arrest warrant for the local director of the GCC.
That is terrifying.
Right. So the new bill aims to replace criminal penalties for minor, non-fraudulent administrative breaches with standard corporate monetary fines. It drastically lowers the physical risk profile for the executives running the center.
Okay, so we've talked about the friction of simply building the facility. The lights are on, the state of Karnataka is appeased for the month. Let's look at the actual daily work that absorbs all this operational cost.
Let's get into the weeds.
Yeah, let's talk about customer due diligence, or CDD, because we have the Central Bank of India's actual internal policy document, and it really strips away all the marketing gloss. How do these teams actually onboard customers and hunt for fraud?
Well, the policy mandates that the GCC break customer due diligence into 3 strictly defined tiers, and it's based on the risk profile of the customer.
Okay.
The first is basic due diligence. This is applied to a standard retail customer opening a simple checking account. The GCC analyst is executing a straightforward identity verification, basically matching proof of identity and proof of address against certified document.
Right, the stuff we all do when we open an account. Then there is simplified due diligence, right?
Yes, which is deployed in 2 specific scenarios. First, for low-income groups to ensure financial inclusion, where the strict documentation rules are slightly relaxed.
Makes sense.
But interestingly, it's also used for highly regulated corporate entities like foreign portfolio investors or FPIs.
Wait, why would a massive corporate entity get simplified due diligence?
The logic is that an FPI is already heavily regulated by other global authorities, right? So the bank doesn't need to reinvent the wheel on background checks. But, and this is key, the vast majority of the GCC's operational horsepower is dedicated to the third tier, enhanced due diligence, or EDD.
Right, this is for the high-risk accounts. And the policy gives this fascinating list of who gets thrown into the EDD bucket. It includes non-resident Indians, NGOs, trusts, correspondent banking relationships, and politically exposed persons, PPs.
PPs are a massive focus for global compliance.
So I bet.
Because they carry a profound risk of bribery and corruption. I mean, if a foreign government minister or even their immediate family member opens an account, the GCC has to subject every single transaction to intense scrutiny to ensure the bank isn't inadvertently holding embezzled state funds.
And this is where the GCC teams transition from simple document checkers into, forensic accountants. When a complex corporate structure applies for an account, the GCC analyst cannot just look at the name on the application. They have to engage in what the industry calls piercing the corporate veil.
Such a great term.
It really is. They are hunting for the UBO, the ultimate beneficial owner.
Because the regulations require the bank to know exactly which human being is actually pulling the strings and profiting from the account.
Right.
The Central Bank of India policy provides very specific mathematical thresholds for this hunt. If the customer is a company or a trust, the GCC analyst has to dig through the layers of shell companies and holding entities to find the natural person who owns more than 10% of the shares, capital, or profits, or who exercises policy control.
10%. I mean, think about how difficult that is. Imagine an analyst in Pune looking at a corporate account application for a company registered in the Cayman Islands.
Sound like a headache already.
Yeah, and that company is owned by a holding company in Delaware, which is in turn owned by a trust in Jersey. The analyst has to forensically dismantle that structure, request documents from the client for every single layer, and calculate the proportional ownership just to see if a single human being clears that 10% threshold.
And if the entity is an unincorporated association or a society, the threshold moves up to 15%.
But wait, what happens when the structure is intentionally designed to be opaque? Like, what if the analyst maps out 20 different shell companies and ownership is perfectly fractured so that no single human being hits that 10 or 15% mark? Does the bank just give up and approve the account?
No, absolutely not. The policy has a very strict mandatory fallback.
Oh, really?
Yeah. If no natural person is identified through those ownership thresholds, the senior managing official, so someone like the CEO or the managing director, is legally declared the beneficial owner for compliance purposes.
Interesting.
The regulatory logic is that the buck must start with a human being. So the GCC team then must positively establish the identity of that executive using independent, reliable sources.
Which means cross-referencing against India's national biometric ID system, Aadhaar, or pulling their tax ID, the PAN card. And if they don't have those, they have to file a specific legal declaration called Form 60. The GCC basically leaves no stone unturned. And furthermore, the analyst must document the nature and purpose of the relationship. They have to answer the fundamental question: why does this obscure, multi-layered trust need a commercial checking account at this specific bank?
Because the intention must align with the economic reality. If the stated purpose doesn't make logical business sense, the account is declined.
Here's where it gets really interesting, though. I was reading through the section on how aggressively the GCC must pursue these documents, and I hit a complete paradox. It's called the tipping off rule.
Oh, the tipping off rule is one of the most critical mechanisms in anti-money laundering protocols.
It's wild. The policy states that if the bank suspects money laundering is actively happening, but they believe that performing the standard customer due diligence process will alert the criminal, the GCC team is instructed to stop the CDD process entirely.
Just drop it.
Yeah. They drop the investigation, they don't ask the customer for any more documents, and they immediately file a suspicious transaction report.
To understand why this inverted logic exists, we have to look at how money laundering actually operates in the real world.
Okay.
These GCCs are enforcing the standards of the FATF, the Financial Action Task Force. Imagine a scenario where a GCC analyst notices a series of bizarre wire transfers and sends an email to the client asking for a standard utility bill and an explanation of the funds.
Right, just a routine compliance check, nothing crazy.
But the client is a sophisticated money launderer. The moment they receive that email, they know the bank's algorithms have flagged them. They are tipped off. Within 60 seconds, that launderer will log into their portal, liquidate the account, and wire the $5 million to a non-compliant jurisdiction, a country lacking extradition treaties or appropriate AML laws, and the money vanishes forever.
Wow. So by stopping the investigation and silently filing the suspicious transaction report, the GCC analyst is essentially playing dead. They allow law enforcement to get a subpoena and freeze the assets at the clearinghouse level before the criminal even realizes they are exposed.
Exactly. The element of surprise is literally the only advantage global law enforcement has, and the GCC is required by law to protect that surprise.
That is fascinating. And I think this transitions us perfectly into the ongoing life cycle of an account. Because catching a criminal at the onboarding phase is just the door, right? What happens when the account is open and the money starts moving? This is where the GCC shifts from investigators into real-time monitors.
Right, and this phase is termed ongoing due diligence.
Hmm.
The GCC isn't just looking at isolated single transactions. They are continuously comparing a customer's real-time transactional velocity against their stated profile and source of funds.
So if a customer declared on their application that they run a small cash-based local bakery, but suddenly their account is receiving massive daily international wire transfers from Eastern Europe, the system is going to throw a massive red flag.
A huge red flag, yeah.
And the legal reporting framework surrounding this monitoring is incredibly intense. It's governed by the PMLA rules, the Prevention of Money Laundering Act. There are 3 main reports these GCC teams are constantly generating and filing.
The most critical one is the STR, the Suspicious Transaction Report. If the GCC analyst investigates an alert and concludes the transaction lacks economic rationale or appears illicit, they have exactly 7 days to file this report.
7 days. And then you have the CTR, the Cash Transaction Report. This one is entirely objective, right? There is no suspicion required.
Right, purely numbers-based.
Any cash transaction over 10 lakhs, which is roughly 1 million rupees, must be reported. But the rule actually goes further. Any integrally connected series of cash transactions that add up to over 10 lakhs in a single month must also be reported.
Which requires serious data aggregation.
Yeah, the GCC has to aggregate all this data across the bank's branches and file it to the FIUIND, the Financial Intelligence Unit of India, via their Finet portal by the 15th of the following month.
And finally, there is the CCR, the Counterfeit Currency Report, which is filed whenever forged notes or forged valuable securities are detected in the physical branch network.
I found the internal guidance on what actually triggers an STR absolutely captivating. It's not just, oh, large amounts of money.
Got it all.
The policy gives the GCC teams a highly specific, indicative list of behavioral red flags to hunt for. For instance, an unexplained large cash withdrawal from an account that has been completely dormant for 3 years.
Very suspicious.
Or a complex RTGS, a real-time gross settlement transfer that has absolutely no economic rationale.
One of the most specific red flags in the document involves multi-level marketing companies, or MLMs.
Oh, this was so interesting.
The policy explicitly states that if an MLM company suddenly requests a large number of multiple checkbooks, the GCC must flag it immediately.
Because MLMs are notorious for using massive volumes of physical checks to create incredibly complex, untraceable webs of payouts to obscure the original source of funds. The GCC knows the playbook. And then there is the money mule protocol.
Money mules are a massive vulnerability in global finance. Criminal syndicates will recruit innocent people or sometimes complicit individuals to use their personal retail accounts to briefly hold and transfer illicit funds, basically breaking the chain of custody.
And the GCC tracks this using velocity algorithms, right?
Yeah.
If an account receives quick, unexpected deposits or wire transfers, and then those exact funds are moved out within hours or days, leaving the account empty again, the system flags that account as a suspected money mule.
Exactly.
But wait, what if that's just a parent receiving a bonus and immediately paying their kids' college tuition? Doesn't it throw a massive net over innocent people?
That is exactly the tension in transaction monitoring, and it is why the bank cannot simply auto-freeze the account based purely on an algorithm.
Oh, I see.
The protocol dictates that the GCC must apply a mandatory 30-day enhanced due diligence monitoring period.
Okay.
A human analyst reviews all alerts generated during this window, verifies the underlying corporate status of the entities involved, and makes a reasoned determination before ever preparing an STR.
What blew my mind in the policy document is that the GCCs don't just monitor the customers. They are actively monitoring the bank's own employees.
Insider threat is a critical, often overlooked component of risk management.
I would have even thought of it.
A corrupt bank employee can bypass millions of dollars of security infrastructure.
The policy lists internal behavioral red flags for the GCC to watch for. If a bank employee is living a lavish lifestyle that is clearly unsupported by their salary, like driving a 6-figure sports car on a teller's salary, that is a massive red flag. But this one is my favorite. An employee who refuses to take a vacation.
It seems completely counterintuitive, right?
Yeah.
Most managers would view an employee who never takes a day off as incredibly dedicated.
A star employee.
Right. But in the world of financial crime, a person running a complex embezzlement or ledger laundering scheme literally cannot afford to take 2 weeks off. The moment they leave, the person filling in for them will immediately spot the anomalies and unreconciled accounts in the books.
The architecture of the defense is brilliant. I mean, think about the pressure on a GCC worker for a minute. You are parsing thousands of international wire transfers a day. Your specific job is to make sure that the originator and beneficiary information is perfectly, flawlessly attached to every single wire message.
It's intense pressure.
If it's not, you have to suspend the transfer. Why? Because you are actively enforcing the UAPA, the Unlawful Activities Prevention Act, and the WMD Act, literally preventing funding for weapons of mass destruction.
If we connect this to the bigger picture, when you view the GCC through the lens of these specific operational tasks, it completely reframes what these centers are.
Yeah, they're not just back-office data entry.
They are the immune system of the global financial network. They are actively filtering out the proceeds of drug trafficking, organized crime, and terror financing before those funds can settle into the broader legitimate economy. If a GCC analyst in Pune misses an alert or clears a wire transfer without verifying the beneficiary, a designated terrorist organization gets funded.
That is a staggering responsibility. But here's the catch. Catching a money mule or blocking a terror-linked wire transfer only protects the public from criminals. Who protects the bank itself from collapsing under its own weight?
That's the other half of the coin.
Right, because while the AML team is hunting criminals, the floor right above them in the GCC is mathematically proving to global regulators that the bank won't trigger another 2008 financial crisis.
This brings us to the alphabet soup of global standards, specifically international tax compliance and banking stability metrics. Let's start with tax compliance, FTSA and CRS. This is where you really see the sheer jurisdictional reach of global powers manifesting in the daily operations of an Indian GCC.
Okay, so FATS is the Foreign Account Tax Compliance Act. It is a United States law. It basically requires every foreign financial institution in the world to identify and report any accounts held by U.S. taxpayers directly to the IRS.
Right.
And CRS, the Common Reporting Standard, is the multilateral equivalent for non-U.S. global tax residents. But wait, if the bank is an offshore entity, how does the U.S. IRS have the teeth to force an Indian GCC to freeze an account to Mumbai?
The leverage is the U.S. dollar.
Ah.
If a foreign financial institution refuses to comply with FATSA, the U.S. government can impose a massive withholding tax on all of that bank's U.S. source income, or ultimately cut them off from the U.S. dollar clearing system entirely.
And no bank can survive that.
No global bank can survive without access to U.S. dollars. So the Indian GCC is forced to act as a proxy enforcer for the IRS.
The GCC teams are mandated to make customers fill out specific self-certification forms, income tax rules 114 F, G, and H, and the policy is ruthless on this. If a customer refuses to comply and certify their global tax residency, the GCC doesn't just send a polite reminder email. They execute a hard block on the account.
A hard block.
Yeah, you cannot access your money anywhere in the world until the Indian GCC clears your U.S. tax compliance form.
And while one department of the GCC is enforcing U.S. tax code, another massive team is managing banking stability reporting.
Right.
After the 2008 financial crisis, global regulators created massive data-heavy reporting frameworks to ensure banks maintain enough capital to survive an economic shock. We are talking about Basel III and III, Dodd-Frank, CCR, the Comprehensive Capital Analysis and Review, and DFFS, the Dodd-Frank Act stress testing.
I playfully marvel at the absurdity of this. You have operations professionals in Hyderabad calculating market risk, credit risk, and operational risk across a bank's entire global portfolio to ensure a massive American bank meets Swiss-born international banking stability standards.
It's a truly globalized process.
It really is. The sheer volume of data required for a CCR stress test is incomprehensible. How does a team of humans actually compile this without making a catastrophic math error?
Well, they don't rely purely on humans for the aggregation anymore. The workflow design required to achieve this at scale without error is really fascinating. The Reliable Group Playbook details how GCCs use virtual employees to handle the Basel and CCR reporting.
Virtual employees, we're talking about sophisticated software bots, right?
Yes. Think of these virtual employees like automated combine harvesters in a massive global wheat field of financial data.
I like that analogy.
They are sweeping up millions of data points, loan balances, counterparty exposures, risk scores, market volatility metrics, threshing out the formatting errors, and packaging the clean, mathematically verified data into neatly tied bales for the human risk officers.
Wow.
They cross-check the current massive data set against prior quarterly filings, and they mathematically flag any variances that fall outside expected parameters.
But the crucial detail in the documentation is that the bot does not just hit submit to the Federal Reserve. Every single virtual employee has a named human owner within the GCC. There is a meticulously documented scope of work and a SOX-aligned audit trail.
Right.
SOX being the Sarbanes-Oxley Act, which dictates strict corporate governance over financial record accuracy to prevent another Enron-style collapse.
The architecture here guarantees zero opacity between the offshore execution and the onshore regulatory review. When a bank examiner from the Federal Reserve is sitting in an office in Washington, D.C., reviewing the bank's stress test inputs, they are looking at the exact same SOX-aligned audit trail, the exact same digital view as the human operations owner sitting in Hyderabad.
Since we are talking about bots and virtual employees sweeping up data, let's look at the actual AI reality hitting these centers right now. Because the massive historically manual execution factory that we've been describing is currently undergoing a brutal, rapid modernization driven by artificial intelligence and digital workflows.
We are definitely witnessing the death of the pure manual data entry hub. Take the onboarding process, for example. The Central Bank of India policy outlines the mandatory adoption of digital KYC and VCIP.
VCIP, right. The Video Customer Identification Process.
Exactly.
And I was reading the requirements for VCIP, and it is not just jumping on a quick FaceTime call with a customer to look at their passport. The compliance security requirements are wild.
It is a highly choreographed, legally binding digital interaction. The system requires real-time audio-visual geotagging to mathematically prove the customer is exactly in the jurisdiction they claim to be.
They can't just be using a VPN.
Right. It requires end-to-end encryption. Before a bank can even launch a VCIP platform, it has to undergo intense software security audits by certified third parties.
And even after the software is running, the GCC has to run concurrent audits. A second human auditor is literally watching the video feed silently or reviewing it immediately after to ensure the integrity of the process isn't being spoofed by deepfakes,
Right.
or that the customer isn't being physically coerced off camera.
And AI isn't just used in the onboarding phase either. It is heavily pushed in ongoing transaction monitoring. The internal policies actively encourage the adoption of artificial intelligence and machine learning to create system-driven, effective, ongoing due diligence.
Which makes sense because human beings simply cannot monitor the velocity of modern digital payments in real time.
It's impossible.
Yeah, if a bank processes 10 million UPI or RTGS digital payments a day, you can't have a human review each one. The AI models are trained to see macro patterns across millions of transactions that a human investigator would miss, throwing an automated alert the second a transaction drifts even slightly from a customer's dynamically updated risk profile.
But this brings us to the ultimate question of this modernization phase.
Right. So what does this all mean? Are these 1,000-person GCCs going to disappear in 5 years, replaced by a single server rack running a massive, large language model?
It's what everyone is asking.
I love the source text for its brutal honesty here. The industry playbooks note that bank executives absolutely love to tout AI and frictionless finance in their press releases. But behind the scenes, those massive human GCC teams are still there.
They're not going anywhere.
They're still manually clearing the incredibly complex, nuanced alerts generated by the AI. They're still repeating tedious remediation work after regulators find gaps in the audits.
AI in the context of global compliance is a tool, not a replacement. The Reliable Group Playbook explicitly calls this the humans approve principle.
The humans approve principle.
Yes. AI and virtual employees can compress the grunt work, they assemble the massive data sets, they flag the variances, they highlight the anomalous wire transfers, and doing so compounds the GCC's EBITDA margins by 100 to 300 basis points.
Which we know is massive.
Right. But, crucially, humans approve every customer-impacting decision.
An AI does not decide to freeze a customer's account for terror financing. An AI does not decide to execute a hard block under FATCA. A human analyst in a GCC reviews the AI's evidence, applies regulatory judgment, and makes the legal call. It's human accountability backed by machine speed.
Exactly. AI isn't replacing the GCC, it is elevating it. Because the repetitive grunt work is automated, these Indian GCCs are moving rapidly up the value chain. They are evolving from simple data entry hubs into centers of excellence for predictive analytics, supporting complex algorithmic trading desks, and integrating blockchain technologies for real-time payment processing.
It is an incredible journey we've taken today. We started by looking at the hard financial reality of why global banks build these centers in India, escaping the 60% vendor markups to build compounding institutional equity. We waded through the dense, almost suffocating thicket of local compliance. Those 2,051 annual filings just to keep the facility doors open. We dug deep into the intricate, high-stakes forensic accounting of customer due diligence, hunting for ultimate beneficial owners, and navigating the bizarre paradox of the tipping-off rule.
We saw how they act as the active immune system of the financial world, tracking money mules and suspicious RTGS transfers while simultaneously balancing the massive mathematical reporting weight of U.S. ATISA laws and Basel III stability metrics.
And finally, we looked at the AI horizon, where bots act as data combine harvesters, but humans still pull the trigger on the final legal decisions. So the next time you pull out your phone, tap that sleek banking app and seamlessly transfer funds across the globe in seconds. I want you to remember that there is no magic supercomputer in a vault. There is a massive, highly regulated, incredibly sophisticated engine of human expertise in India, making that seamless illusion possible.
This raises one final provocative question. We've seen how quickly these centers are moving from basic data entry to advanced risk modeling. If the AI and predictive analytics inside these India-based GCCs eventually become so advanced that they can perfectly map, model, and predict global financial crime before it even happens, does the offshore back office eventually stop being just a support center? At what point does the GCC become the actual, undeniable brain of the bank, rendering the traditional Western headquarters purely ceremonial?
Wow. When the app is just the face, and the GCC is the brain who really controls the global bank, it's a fascinating thought to leave you with. Thanks for joining us on this deep dive.